Have you ever felt like your head is just spinning, trying to figure out the world of investing? Yeah, you are not alone. So today, we're going to cut right through all the jargon and demystify the most common types of investment funds out there. And by the end of this, I promise you'll have a much clearer picture of where your money could be working for you. Let's dive right in.
Right, you've heard all the terms thrown around. Index funds, mutual funds, ETFs, hedge funds. It's like an alphabet soup of finance. But what is the actual difference between them? And, more importantly, which one might actually be right for you? Well, that's exactly what we're going to break down piece by piece.
Okay, before we get into all the differences, let's start with a really simple question. What even is a fund? So think of it this way. Imagine you and your friends are planning a big birthday party. Everybody pitches in a little bit of money, and together you can buy this huge cake, tons of snacks, way more than any single person could have bought on their own. An investment fund is pretty much the exact same idea. A bunch of people pool their money together to buy a whole mix of things like stocks and bonds. It's a way to own a little piece of a lot of things.
Okay, so now that we've got that down, let's start with the one you've probably heard about the most, especially if you spend any time online. We're going to call this one the simple default, the index fund.
The secret to an index fund is that it's not very secret at all. There isn't some genius manager in a fancy office trying to pick the next big stock. Nope. Instead, the fund is managed passively. All it does is buy all the stocks on a pre-existing list, an index, and its only goal is to match the performance of that list. No more, no less. It's really that simple.
So, what is this index I'm talking about? Well, just think of it like a scoreboard for a specific part of the economy. For example, the S&P 500 tracks 500 of the biggest companies in the US. Then you've got the NASDAQ, which is really heavy on big tech companies like Apple and Amazon, or the Dow Jones, which follows 30 huge established industrial companies. An index fund just picks one of these lists and copies it. And here is where that simple passive strategy really pays off, literally. Because there's no high-powered manager or research team to pay for. The annual fees, they're called the expense ratio, are incredibly low. I mean, we're talking at fractions of a percent.
So to put that into perspective for you, an expense ratio of just 0.02% means you'd pay only 20 cents a year in fees for every single $1,000 you have invested. That is remarkably cheap. And over many years, that tiny difference in fees can compound into thousands, even tens of thousands of extra dollars in your pocket.
And hey, don't just take my word for it. The legendary investor Warren Buffett has been saying this for decades. He basically argues that for most people, trying to outsmart and beat the market is a losing game, and that a simple, low-cost index fund is the most sensible path forward.
Now, there is one little detail you've got to understand. Unlike a stock that you can buy or sell instantly, a traditional index fund is only priced once a day. Any order you put in gets executed at a single price that's calculated after the market closes. For most long-term investors, this really isn't a problem at all, but it is a key difference to be aware of. So, if index funds are the simple, passive approach, what's the alternative? Well, that brings us to what we'll call the active bet, mutual funds.
Okay, here's the core difference in a nutshell. While an index fund just passively follows a list, a mutual fund is actively managed. This means you're paying a professional manager, or a whole team of them, to constantly research and pick investments with one big goal in mind, to beat the market. And the trade-off for having that expert at the wheel? Well, as you can see, the fees are a whole lot higher.
And this really brings us to the million-dollar question, doesn't it? Is it worth paying those higher fees? I mean, beating the market sounds great, but study after study has shown that over the long run, the vast majority of these active fund managers actually fail to do it consistently. It's an incredibly difficult game to win.
Now, let's shift gears and talk about a completely different league of investing. Seriously, this is not for the everyday investor. This is the high-stakes game of hedge funds.
So, the very first thing you need to know is that hedge funds are exclusive. They're typically only open to what are called accredited investors. We're talking people with a really high net worth or income. And this exclusivity exists for a very good reason. The strategies these funds use carry a significantly higher level of risk.
So what kind of strategies are we talking about here? Well, things like short selling, where you're literally betting that a stock's price will fall, or using leverage, which is just a fancy word for investing with borrowed money to amplify potential gains, but also potential losses. It's all about chasing these huge returns, which of course comes with the risk of huge losses.
And the fees? They're in a completely different universe. Hedge funds are famous for what's called the 2 and 20 model. That means they charge a 2% fee on all the money they manage every single year, plus they take a 20% cut of any profits they make for you. So, to make that worthwhile, they have to be aiming for some incredibly high returns.
All right, let's come back down from the world of high finance to something much more accessible for everyone. This is our final category, and you can think of it as a modern, really flexible hybrid, the ETF, which stands for Exchange Traded Fund.
Now here's the magic of an ETF. It really takes the best of both worlds. Just like an index fund, it holds a diversified basket of hundreds of different stocks. But, and this is a big but, it combines that diversification with the key feature of an individual stock. You can trade it all day long.
See, remember how we said those traditional funds only trade once per day after the market closes? Well, that's where ETFs are completely different. Their price changes constantly throughout the day, just like a regular stock, which lets you buy or sell them literally any time the market is open. This gives you a level of flexibility and control that traditional funds just can't offer.
And you know what the best part is? Even with all that added trading flexibility, most ETFs operate just like index funds. They're passively managed, they're designed to track an index like the S&P 500, and because of that, they also have those super low fees we talked about earlier.
All right, we've covered a lot of ground here. We've journeyed from the simple and passive all the way to the complex and high stakes. So let's pull everything together now and take a look at the big picture.
Think of this as your quick and dirty guide. If your goal is simple, long-term, maybe set it and forget it investing, an index fund is probably your go-to. If you're someone who really believes a skilled manager can beat the odds, you might look at a mutual fund. If you've got a high net worth and a big appetite for risk, hedge funds are on the map. And finally, if you want those low-cost benefits, but with the trading flexibility of a stock, an ETF is that perfect hybrid option.
So, what's the bottom line here? Why does all this matter? Well, for the vast majority of people, especially those who are just starting out on their investment journey, the simple, broadly diversified, and very low-cost approach that you get from index funds and ETFs is almost always the most recommended and sensible place to start building long-term wealth.
So there you have it. We've cleared away the confusing jargon, we've laid out the main paths on the investment landscape. You now have a really solid foundation to build on. So the only question left is, now that you've got the map, where will your journey begin?